So typically, I'll start these on the tape podcasts with a lyric from a song. But you know what? I had a lot of time to think. By the way, this is the On the Tape podcast. I am Guy Adami, always joined by the very handsome Danny Moses and the ever-shrinking Dan Nathan. Today, we have the joy of Stuart Sopp, the CEO of Current. He will be joining us for the entire podcast. So we have a lot going on. And as I mentioned, a lot of time to think. I was on the plane home last night from Omaha, Nebraska. And if you've flown with me, which many of you have not, you know that I basically sit in my seat and I stare forward. And by staring forward, I think about a lot of things. And last night I was thinking about how do we start this podcast? And we're doing it today on Friday because we had Apple earnings yesterday. We wanted to get on the backside of that. And we obviously had a jobs number this morning that we will discuss. But it came to me knowing that Stuart was going to join us. He reminds me of one of these 16th century English poets. He's got what do they call those things when you put it on your head with the little bun, right? The man bun. He's very handsome. He's got the beard. He's got the accent. He's bright as shit. Like, he's a poet. Like, he's a throwback from another time. So I say to myself, all right, what poet does he sort of look like? And it dawned on me, because I took poetry drama in college, that he looks remarkably like Sir Thomas Wyatt. And then I said to myself, well, Sir Thomas Wyatt has a very famous poem, and that's exactly the poem that lends itself to this episode. And just indulge me yet again for just a minute. The name of the poem is They Flee From Me. They flee from me that sometime did me seek, with naked foot stalking in my chamber. I have seen them gentle, tame, and meek, that now are wild and do not remember. And Danny Moses, think about this for a second. What has been fleeing? Deposits have been fleeing from different regional and smaller banks in record amounts. They are fleeing from the people they sometime did seek. And as we sit here today, more and more banks are seemingly going by the wayside. The bigger banks are getting bigger. The whole too big to fail stuff that we were sort of railing against for years is alive and well. Market's a bit on its horse here today as we speak, but there's so many things to talk about. By the way, Stuart, welcome. And what are your thoughts about me comparing you to Sir Thomas Wyatt?
That was fantastic. Thank you. It's always great to be here. I have never been compared to a poet before, so I appreciate that. That was a new one for me. But obviously very flattered.
So, Guy, a little housekeeping. So you were in Omaha. It must have been it was your high school reunion, you, Charlie
Yes.
Munger, and Warren. And you were a year behind them. So they just kind of put a bunch of the years together for Omaha High. Is that what they did?
I think when you get to a certain age, they try not to do it by year. They try to do it by those of us that are still alive.
Yeah.
So, by the way, Charlie was 4 years ahead of me. I think he was a senior my freshman year, and I think Warren was somewhere in between. But we had a great time in Omaha. I got to see Creighton University for the first time in a while. It was a great trip, but I did a lot of introspection, and there's no doubt that we can't bury the lead here, Danny. I mean, banks are front and center. We're seeing it each and every day, seemingly. At least the equity of these banks are getting lambasted, justifiably so, not justifiably so. It doesn't matter. People say there's not a banking crisis, maybe not a systemic risk, but there's clearly a problem in terms of the equity. And, we'll have a conversation with Stuart about how this manifests itself into the economy.
You don't think that Jerome Powell's a poet when he says that the U.S. banking system is sound and resilient? That was pretty
amazing.
poetic as far as I'm. But Guy, we come on the show. I say this all the time. We don't know what you're going to come out with. I thought you were going Gordon Lightfoot today for sure, because you had to be a fan of Gordon Lightfoot. So I had a lyric to sing that is about Jerome Powell. Ready?
Go.
If you could read my mind, love, what a tale my thoughts could tell. That's Jerome Powell, right? You just read this guy's mind, right? So let me talk about the banks for a second. I think that the deposit outflow story is over. I think the deposit changing within the bank and interest bearing from non-interest bearing is not. I think the Fed has basically implied and the Treasury have implied that they're not going to let people lose money as depositors, even if you're over 250. I think that's pretty clear. So that part, I think, of the quote crisis is over. Now we're on to bring back 2008, blaming short sellers. Let's do a short ban could be coming. That type shit's flying out there right now, right? All short sellers did was identify the problem 6 months ago to tell people what was going to happen. but did the regulators, did the San Francisco Fed do anything? Did the Fed do anything? And one of the most telling things was when Powell was pressed about, from Leisman, I believe, about what happened in February meeting when you were alerted, basically, that Silicon Valley may be, quote, in trouble. And he didn't answer. And then Leisman pressed him again. That was a very embarrassing moment, I think, for the Fed in general. But listen, here's the thing. When these banks go up for, quote, sale, the beauty pageant or the non-beauty pageant, if you want to call it in this regard, it's not just about the securities anymore. Banks are getting a holistic look at the other little banks. So what they're looking at commercial real estate. They're looking at loan loss provisions, looking at credit. So it's not just about the transfer of these securities onto a bigger balance sheet. And that's actually what's happening right now, in my opinion. So when JP Morgan had to look at First Republic or these other banks, we're going to see more and more of this potentially happening. It's not just about the securities anymore. It's buying this franchise. And I think that's more telling. And again, we know there's bigger issues at the bank, which are slower moving. They're elephants, so to speak, in commercial real estate. So I think we're in the early innings, but I do feel like the crisis of depositors being at risk is kind of past us at this point.
Yeah, so interesting. Stuart was on CNBC's Fast Money last night. That was Thursday. And one of the first questions he got from Melissa was about PacWest and really about some of the things that you guys both just discussed here. And it's interesting, Guy, you mentioned the too big to fail, that, all of this regulation since the financial crisis, right, in the years after was really meant to kind of diversify risk across the banking system. And now it's coming back up into it, right? And it's coming with a bit of moral hazard. Stuart, that was a term that you used last night. When you think about the company that you and Trevor built in the wake of the financial crisis, you were squarely looking at some of these large institutions. Help us think about this through your lens, right? Because to Danny's point, the regional banking equity is literally, it's like a rounding error right now, right? They took out the biggest ones for all intents and purposes over the last month and a half. Now we're looking at ones that have sub-billion dollars in equities. They still have obviously huge assets and liabilities on their balance sheets, right? And those are the things that are being backstopped. Consumers' money, deposits at those institutions are being backstopped. What does it mean, like, to you and to FinTech? FinTech has been this massive theme, trying to disintermediate, trying to actually serve customers that were not well served, whether maybe it was by a really small bank or a really large bank. What does it mean now that all of these major money centers are just getting, way big here, and they're really gobbling up, everything below it?
Yeah, I think with FinTech specifically compared to like regionals, right? If you can make that comparison, it's a business model differentiation, which is what I was kind of bringing up yesterday. So banks, obviously, long duration, there's a duration mismatch. It's kind of surprising that the market broadly is surprised by this. Maybe they're surprised by their risk management. I think that's probably where we're all surprised. And also the lack of regulation or regulatory oversight from this, massively accelerated rate hikes. It's obviously signified that maybe their treasury departments or whatever it is, their risk management is not as good as it should have been. And then for fintechs like us, we conflate banking in the sense of providing banking services, but we don't really have this duration problem. We have a payment solution, right? And so you're really seeing the highlight of those two business models and the fact that we're probably a lot safer. When it comes to, like, when I back things up a bit, I think, really high level, FRC that's now gone under, that was identified back in March, right? So when SVB went under, everyone was like, okay, FRC is in trouble. The regulators knew it. The banking fraternity knew it. And I think that was basically a tale. But what we're seeing right now, this sort of smaller, low market cap, low float regional banks, they're being attacked from the equity side first, and then the deposits are fleeing. And that's a new phenomenon that we're seeing right now. And I think it's like slightly unhealthy, right? Because these other banks like Signature, SVB, Silvergate, they were basically serving a more affluent, more wealthy community, right? That was way over the 250K FDIC, more digitally savvy. These regionals are very local. They're basically part of the GDP of the mom and pop shops, the franchisees, your dental or your vet, that's how they get their credit, and that's where credit creation and growth is really coming from. And so attacking these banks to make a quick buck, I think is obviously not great, but in terms of the concept of that, but it's actually going to affect the way that this country is going to grow going forward.
Let me just say that the Fed, let's go back here. This is really about quantitative easing, becoming quantitative tightening. And in late 2021, Powell told the market that QE was over and QT was going to begin. These banks decided at that point to plow in to these securities ahead of a $9 trillion potential unwind, or at that point, $8 trillion potential unwind in the marketplace. And so we knew, right, that if you front run that legally, if you're these huge funds that buy these securities, why would you step in and buy? These banks decided to do that, right? So I'm not, this whole thing about short sellers causing anything to me is nonsense, because if the banks don't need to raise equity, then the stock price should matter over time and it should recover. But they missed their window potentially to raise the equity. And yes, I agree, it's self-fulfilling. And let's think back to the global financial crisis. Yes, were there hedge funds out there that may have shorted Bear Stearns and subsequently pulled their assets from the bank potentially? There was certainly some of that going on. This is very different in my opinion. Stuart, you just said this was known for months. This was known for 2 or 3 quarters that this was going to happen. So I mean, I have a real problem with people out there, quote, blaming short sellers. Of course, there's going to be people that manipulate over time, but that's, I think that's a one-off here. So again, this is forewarning. And let me just say that QT, they can pretend, they got the balance sheet down another $60 billion last night or whatever when I saw the report. That thing is done, because that will be the most disruptive factor going forward, because that makes the situation even worse for these banks, in my opinion.
Yeah, I don't disagree with you, Danny. And I think when you look at where we are with these smaller regional banks, there's 550, 600 of them that are publicly listed in the country. I just think that we're slowly starting to see the tail end of this. I think we'll have a few more. But, I think, as Guy already said, it's not systemic. And we'll probably see this sort of a halo of this over the next few months. Those, as these short sellers sort of do their job. I think higher level, we're seeing a duration bubble burst. And I think that's really important. In 2008, we saw the banks being attacked, but it was a credit problem then. And that's a very different problem that we're seeing today.
I know Danny and Dan have thoughts on this, Stu, but I'm going to ask you, and they can chime in on the back end. So we talked about what does this mean longer term, and here are my thoughts on it, and I'm curious as to what you think. So obviously, in terms of what we're seeing with these small and regional banks, the equity is getting sold off. I understand that. I think many more of these banks are going to go by the wayside. I think what we're seeing, what we'll continue to see, Danny doesn't think we're going to see that much more deposit moves, but the bigger banks are going to get bigger. But here's my sort of premises to this whole thing, and this is how I wrap my head around it. If you think about the lifeblood of the United States economy, it's access to credit, and banks are obviously at the forefront of that. Regional banks are sort of at the epicenter because small business is such a huge driver of employment in this country, and they have their finger on the pulse of local businesses. Almost by definition, they're immersed in the communities that they serve. If those banks are compromised, which I think we all agree that they probably are, almost by definition, the customers that they serve will be compromised. So those customers, their access to credit is going to get more difficult. It would have been more difficult in the first place, given all the regulation, more so now. So if their access to credit sort of gets difficult or almost entirely goes away, there's going to be the brakes are going to be put on the economy in a meaningful way. Now, we're not going to feel that tomorrow, Stu. It's not going to happen next week. But to me, that's the real danger of this entire thing. Not necessarily that some of these banks are going away, but what the knock-on effects are going to be. Thoughts on that?
Yeah, I couldn't agree more. That's really where my main worry is, that this is indicative of credit creation slowing down in a significant way to the backbone of America, of where the real production and productivity is. Blue-collar workers, people that current services, from a payments and banking point of view. And that's really where my main worry is. I think we went from a liquidity crisis to a solvency crisis from this duration bubble bursting. I think with Powell saying, I think he did a good job, by the way, yesterday. I thought he, or on Wednesday, he was pretty good. And I think he sort of I know it's not popular to say that, but I think he threaded the needle, in an okay way. But unfortunately, they're going to need to see something break. And then they're going to look, they're driving the car with the rearview mirror the whole time. And I think at this point, we've raced so quickly, so fast. And when you pop a duration bubble, you don't know where things are going to break. And I think when you talk about the people that you just talked about, Guy, we're talking auto loans, credit card debt, with the normal things that get you to work, that keep your family going, and all that other stuff. I think is harder to service. It's more expensive, and there's when credit creation comes down and all these banks are going away and getting rolled up into J.P. Morgan, they're not going to service those clients in the same way. So we're seeing like material, I would say, medium to long term destruction here.
Yeah, I'll just say this. I did not think Fed Chair Powell did a good job. I thought he seemed very, very uncertain. And I'm just going to give you one example of it. So there was, I think it was Matt Boesler from Bloomberg News asked him about the way, Q1 GDP had been tracking. And he's just wondering, this is his question, if you can kind of elaborate on how and why you're optimistic that a recession can be avoided, given that the Fed's staff's forecast, possibly also the broader committee's forecast, as well as, and also, of course, most private sector forecasters are for a recession. And he just kind of bobbled around a little bit and he said, this is the quote, okay? He said, it's possible that it's different this time. I mean, that was part of his answer. So Danny, when you heard him, and really, I felt he had far less of a command. And Guy, you mentioned this on many occasions, okay? I mean, he's got a tough job right now, no doubt about it. We don't have to get into why the job is so tough. But again, I think he mentioned it. Obviously, we know what their dual mandate is: price stability and maximum employment. The problem is, and we can talk about the jobs report from April right now, there is too much demand for jobs. That has been the stickiest part of inflation right now. The way, if you were to look at commodities and you'd say to yourself, they're actually signaling, a recession, right? But on the jobs front, it's a very different story. I just don't know how he could use those words. It's possibly different this time.
What are we expecting from the guy who thought inflation was transitory? I don't understand the expectations for people. I feel bad for him because he's in a really tough spot, but I think the Fed now is a sideshow, and people that are complaining, not necessarily you, Dan, about his performance, just accept the fact. No one wants to accept the fact we're going to a period of sustained higher rates. We're going to have a real economic cycle that we haven't had for 13 or 14 years. And I think that adjustment, people want to make excuses and blame the Fed. People need to be prepared for this. And I've told you before that when you listen to these conference calls, be very attuned to the CEOs that blame the Fed or even talk about the Fed. The ones that just manage their business through it, I think are going to be obviously in much better shape. And the CEOs that have been through this type of thing. So I do think I think the Fed's now a sideshow. It's a real fundamental tape from here. I do think, though, that the balance sheet issue with QE and QT will come back to the forefront. I think that's where the Fed's going to be very, very involved. And I do think that's going to reverse at some point. But I have no expectations for them, at the Fed at this point, given everything that's happened in the banking system and then with all the misguided forecasts on inflation.
As we said earlier, we waited till Friday morning to do this because we wanted to get through Apple earnings. And as they say on CNBC, the all-important jobs number. I just love saying certain things like smash the like button and subscribe on your favorite podcast stores. For some reason, I just think of it and I smile. But that's sort of the idiosyncrasies of G Swizz. But the jobs number came out. 235,000, which was better than expected. I think a lot of people had like 170,000 handle on it. Not that that matters because Danny will speak to the revisions, but the unemployment rate is still 3.4%. So I look at this and say, my God, it's good news for the economy, I think. I mean, it's great that people are employed. It's great that there's still almost twice as many job openings as there are people looking for jobs, although that's coming down as well. The market, Danny, seems to be applauding this for now. Maybe it's on the back of the revisions that you're going to talk about. I'm not sure because to me, a 3.4% unemployment rate continues to make their job, they being the Federal Reserve, exceedingly difficult.
Yeah, I mean, obviously it's backwards looking to a degree, that goes without saying. And you did get a revision lower. So the economy proved that GDP that was revised kind of lower makes more sense now at the 1.1%, which is what jobs were actually doing. I think the Fed is done. I think this is actually, if you're a bull in the market, probably not a bad number. There was a great article in the Wall Street Journal, I believe, last night about operating margins have come in a little bit better than expected in Q1, right? Which means the earnings revisions may not be as bad as people had thought going forward into 2023. Those are bright spots. But to your point, Guy, people that are waiting or believe the Fed's going to be cutting, if that gets pushed out, to me, that's a negative, because with the S&P at 18 or 19 times and Apple at 26 times, yes, I know we can talk about it. It was it was an okay quarter. I mean, down revenues, down earning, down operating income year over year, whatever it might be. It's still a quote safe name to own. And why did people like the Apple story? Because their quote bank is doing so well, which is Goldman Sachs, by the way. How about that for irony? But again, I think we're going to plow ahead here, and I think it's going to be slow going on the economic data going forward. So I believe that the Fed is done, but it was fine. If you're a soft landing person, that's kind of what you wanted to see.
Let me tell you what's not plowing ahead. The S&P 500 right here. Okay, so we had that February 2nd high. It was 4,200. We're at 4,100 right now. We're opening up a little bit as we record this. I think we're up 75 basis points, which brings us a little bit above 4,100 in the futures. And I'll just say this. I don't think there was anything this week from the Fed Chair Powell. It was a hawkish hike. Okay, let's just be clear on that. Okay, if you look at today's jobs data, it doesn't make me feel like there should be anything there that should be perceived to be dovish, Danny. So, I get it. If you were a bull, those revisions, maybe they kind of help a little bit there. And then I think of just the last earnings that we just got from Apple. I mean, they just had their second consecutive revenue decline. Okay, this was year over year as far as revenues, and they just guided down the current quarter in revenues. And I get what you're saying on margin. I get where the U.S. dollar is. I get the exposure that lots of U.S. large multinationals have, and so the dollar might start to be a tailwind, as it had been a headwind in the year prior here. But I just think a little bit about valuation. To your point, we quote John Butters, our friend over there at Earnings Insight at the FactSet blog. And, if you look at the forward PE of the S&P at about 18.5, it's in line with the 5-year average, and it's above the 10-year average. And the biggest differentiator here, I think we all agree that the only way Fed funds is going to come down meaningfully is if this crisis in the regional banks turns into something bigger, right? If the economy slows quicker than most people think, if a recession starts and it ends up being deeper than we kind of think, I think the base case now is that we maybe avoid, back to what Powell said, is possibly different this time, or we have a very shallow sort of recession. I just look at stocks and I say to myself, okay, the VIX got above 20 briefly yesterday. It's going to get kind of creamed today, especially Friday into the close if the S&P can stay up. We talk about this MOVE index. It is picking up a little bit. Danny, before we got on, you just mentioned the volatility that we've seen in Treasury yields. And I just look at the sequencing that our friend Carter Braxton Worth from Worth Charting has mentioned on numerous occasions over the last couple of months. If you look at the start from January 2022, these moves that we've had to into and out of earnings, these big rallies over about a month or two, and then they've come off, and they were making new lows last year. The first time we didn't make a new low was the retest after the October. So now it looks like we're making a series of higher lows in the S&P, but I'll just point you again towards 4,200. I'll point you again towards the VIX where it is. I'll point you again to the debt ceiling that is only going to get dialed up. And I think we're going to have a 25 to 30 VIX in the not so distant future. And I think that this disconnect, this spread between Fed funds, which is going to stay stuck here at 5%. If you're looking at the CME Fed tracker for the June meeting, it doesn't look like there is, small chance of a hike implied. And so I just say to myself, this is actually a perfect cocktail of complacency right now.
Don't mistake my comments for bullishness. I'm just trying to be, I try to be a little bit
totally. But can I make, Danny, can I make one other point? This is, I think, one of the most important things that happened in the equity market this week. Okay, so this is Friday. Last Friday, ExxonMobil reported, their Q1 earnings. The stock made a new brief all-time high. Okay, it traded like $120. It traded as low as 105 yesterday. Okay, it dropped like a lug. And we've been quoting this, and this goes back to Butters guy. He has been telling us in his Earnings Insight blog for quarters now that the contribution to S&P earnings by the energy sector, which basically kept things afloat for all intents and purposes, with a 2-handle or 200 handle for S&P earnings in 2022, was going to start to drop off mid-year this year. And so you better have operating margins start to improve a little bit, and some of these other bigger names. And I would just mention this, is that when you see a name like Exxon drop like that, and it is so well liked by the investment community, it makes me very nervous about an Apple and a Microsoft and NVIDIA all of the risk in the stock market has been transferred to a half a dozen names. And I know we did the carry the weight a couple weeks ago, but it gets more acute now the longer we get into this and the more complacent some of the readings that I see, some of the inputs that I focus on are. And I think we are in for a down 3 to 5% day in the NASDAQ in the not so distant future. And it's going to be led by some of the largest names that I think the investors have just been hiding in.
I don't disagree. And I said on February 2nd high that I'll just use the SPY at 418.31 that we wouldn't hit that again. I was holding on for dear life on May Day, on May 1st, when the SPY hit 417.62 and then quickly reverted. So it did not make a new high for the year. I still stand by, at least in the first half of the year, we will not get back through that. But your boy Butters was the same one that was quoted. To your point, Dan, operating margins a little bit better than expected with 70% of the companies having been reported. That does not set up well, potentially going forward, when you start to compare second quarter versus first quarter, to your point, Dan.
Sir Thomas, I'm sorry. I mean, Stu, and it really is remarkable. I don't know if we can put in the show notes a picture of Sir Thomas Wyatt, who clearly is no longer with us, side by side with Stuart Sopp. It's remarkable. It's sort of like Val Kilmer in that movie with Elizabeth Shue, but I digress. That was a good movie, by the way.
We were talking about that the other day.
Yeah, it's a good movie.
Were you really?
Yeah, we were.
Look at you. I'm in your head.
Yeah.
So you obviously look at all this stuff. Now, when you're in charge of a large organization, you have your head down, you're doing your thing, you're focused every single day, you grind. But at a certain point, you sort of take a step back, look at the world from 30,000 feet. And since last we spoke, the world's changed considerably. So on the margins, in terms of current and what you're doing, is all this a good thing or a bad thing? And I'm not trying to equivocate here. I mean, I think we all agree it's not a great thing, but sometimes you have to look at through the lens of your business and what opportunities it creates.
We have a new credit building product coming out in about 4 weeks. And then we have a cash advance product coming out in a couple of months. We look through things from a macro lens, guilty as charged. And the way we look at it is like, okay, inflation's higher for longer, interest rates are higher for longer. Unemployment is at maximum, is at the maximum level. And so going forward, things can only get worse really from this point, right? So things can only get worse as we draw down savings and credit creation is lower and all the rest of it. And the regional banks get rolled up and all the things that we just mentioned. So from a consumer point of view, that blue collar worker person who is, a backbone of America, they're going to need to build or rebuild their credit. They're going to need access to cash that is fair and transparent. And so we are building those products as soon as possible to get them out to help people in their everyday life. So in one sense, it provides opportunity for us to really fill a gap that is being left behind through this crisis and will continue. And on the other hand, you sort of go, okay, it's not great for the world. When I was last on here, or I was last on CNBC, I was saying it's not systemic and it's, it's the sort of first innings of a problem. I'm starting to get a little bit more worried here. Like I've just said, I think I think the regional banking crisis is a bit of a sideshow, and I think it's going to highlight bigger problems in the broader economy. I think there's other things to look at.
Let me just say this in conjunction with you launching these new products and so forth. And I know you're very careful in your banking partners, you're very careful in building this company. And Upstart, this quote AI lending company, right, was using Cross River Bank as well as Affirm. By the way, I will note that Upstart and Affirm both report earnings on May 8th. Can't wait to hear what they have to say about how that's going. But Cross River Bank got a cease and desist from the FDIC, basically for unsafe or unsound banking practices. And this whole AI, using for lending, which Vinny Daniel will talk about at length. This goes back to Lending Club. You cannot commoditize lending, right? You got to be very careful in how you build your book. And Stu, I know you guys are going to be obviously doing that. And I think this brings up this, whole other element of these quote renta banks, which are kind of out there. We've talked about these regional banks, but these renta banks, they grew during the PPP time era, right? That's how a lot of these kind of banks grew. So I just wanted to get that in there because we've been negative on these companies and these platforms for some time. They tried to hide as, quote, tech companies. But when you start to move into these banking services, right, you have to acknowledge kind of the risks that are inherent in there. And Stu, I know you guys have thought long and hard about that as you kind of build these products in your company.
Yeah, so we connect to a lot of these banks. We connect to 3 of them. So, and you mentioned one of them. And so we're very careful about how we work with them. There's two sides to this story. There's the bank side and how good they are at compliance and regulatory capture and all that other stuff, and their internal controls. Can they scale? Because tech firms like ourselves, fintech firms, we can scale pretty quickly. And then when you're dealing with a regional bank that has only had local growth for 100 years, all of a sudden it gets really complex for them. They're like, okay, this is really quick. Can we hire enough people locally and all this other stuff? And I think that those sort of, as you call them, renter banks or renter charters, they've definitely gone through something. It's not recent, but they've gone through something over the last year to 2 years, and I think they've got a lot better. From our side, we get audited several times through all our banks, and there's third-party audits. There's a Visa audit. Sometimes we do a Fed audit. And so you can imagine, because the nature of how we connect to the banking industry, we have to comply and be regulatorily the best that can be out there, because of course, we're going to be looked at in this way because we can grow so quick. When you talk about regulators, you talk about like the speed of asset accumulation or deceleration, and also customer growth. What the regulators and the administration do not want is a blind spot in the safety and security of the banking system. And so I think this is all good in the sense of, the sort of top-down pressure that we're seeing. I don't think it's that healthy when it comes to crypto, in my personal view. I don't think that has been healthy at all. But when it comes to like traditional banking and how we're being regulated, I think it's good. I think it's time for a lot of us, the fintech community, as well as the sort of renter bank community, to sort of grow up a little bit and get with the program. I would say this finally is that if you're starting a smaller fintech, right, you're a seed stage or you're a Series A, it's going to be really expensive and really hard to get going now, because I think that window is closed.
There's certain things you don't skimp on when you go to the grocery store. One of them is Saran wrap. Because if you get sort of the cheaper brand, it's one of those things that once it sticks to itself, it's impossible to make the roll work. It's just one of those things you want to effing scream. The other thing, of course, is tinfoil or aluminum foil. And I'm a Reynolds wrap person myself. But I do not buy the aforementioned Reynolds wrap to create a tinfoil hat for myself. But I have been, as Danny Moses has been, an ardent supporter of what's going on in the gold market. So tinfoil hats notwithstanding, there is something going on here in gold, Danny Moses. As I've mentioned a number of times, in 2022, central banks globally bought $70 billion worth of gold, 1,131 tons. That was a record. They're on pace to probably duplicate that this year, although there's still half a year or so left. The gold price is finally showing some signs of life. And what I'll tell you is, in terms of the market being long of gold, we're probably about a 60% level as where we were the last time gold was at this level. Point being, the market isn't long yet. And I'm going to tell you again, for the record, everything that we've talked about for the last 32 minutes and all the things that we've been talking about for the last 6 to 9 months, year, 18 months, is walking its way into the gold market. And I said this, and you can use it as a bumper sticker, Danny. Central banks, by buying gold, are hedging their own stupidity, their own inadequacies. So with that, as the gold market continues to sort of hover around this 2,000 level, what are your thoughts, Danny? Does this thing have legs?
Yeah, I think every pullback, and we're getting a slight one today, is a buying opportunity, because it's hard to see any type of scenario other than a perfect soft landing where gold doesn't perform. And, one thing's being lost in this last few days here with Powell and everything is Russia. This stuff's really heating up over there. This supposed drone that tried to attack the Kremlin, blaming the U.S. There's all these reports I'm reading now about Russia's scoping out our underwater cables near our coast and all this stuff. Feels like things are brewing again. And I bring that up because all the geopolitical stuff that still happened, it's getting worse. We're just obsessed with what's going on here with the Fed, lends itself to gold. And I do believe you're right. And I think if we're right on our assessment of the economy and where we're headed, and QT quote ending in some form of QE, which has been going on with the banks' bailouts, so to speak, lends itself to gold. So every pullback guy is a buying opportunity, in my opinion. I'm totally with you.
I think also you're seeing something seismic happen with gold. And the treasury markets. U.S. treasuries used to be the best collateral that everyone could buy in the world. given those geopolitical risks that Danny just mentioned, they're continuing. You've seen the BRICS nations all get together. They want their own payment system. They want their own currencies to deal with energy, which is all fine. I don't believe it's the end of the dollar or anything like that yet. But what I do see is a lack of demand for U.S. treasuries, and that is being replaced with gold. And I think that is just this seismic thing that's not going to go away over decades.
And Stu, you did this. We've talked about it before, but for some new listeners, and our audience continues to build on a weekly basis. So folks that don't know, in a past life, aside from being a 16th century poet, you actually traded currencies, and I'm sure you dabbled in the yellow metal. So when you see this, obviously you're looking at it from a much different vantage point. There's a lot of interesting things going on. Now, forget about the gold market, the precious metals market. The currency market is fascinating, and the moves that we're seeing. Think about what's going on with the ECB. Think about the decisions that they're forced to make. They probably have a bigger inflation problem than we have, and they have an economy that's sort of grinding to a halt, and they have to decide whether or not they're going to continue to sort of tamp down their economy by fighting inflation, and they've chosen to go that route. Very difficult decisions now globally, and that has impact not only on the commodity market, but the currency market, a seat that you used to occupy.
Yeah, that's right. So I still do a cheeky look every morning and look at the whole 50 currencies or whatever it was I used to know to the pip. I think we look very nationally or very sort of at the US for like what's going to break. I think it's important to sort of look at the international community, right? So you just mentioned Europe. Like maybe the Fed doesn't see too much risk here. Maybe they are right? And so if Deutsche Bank goes under, we already saw Credit Suisse go under, right? Is it a Deutsche Bank thing? Is it a European banking contagion that then forces the hand of the Fed? I think that is really important to look at. And in those kind of cases, it looks like Eurodollar. I mean, I don't want to give any investment advice, but Eurodollar looks kind of toppy up here, right? Like at 110, 111, 112. If I was a Eurodollar trader, like back in the day, I would be sort of scaling into shorts here because I see material risk, in the U.S., but also which means the dollar tends to go up in those liquidity breaks, and then there are sort of secular or sort of banking risks that I think haven't been totally played out yet in Europe, and I think that's something. I think you're right, Guy. I think that is something that we should all be looking at, and that's potentially what sort of triggers the next wave of equity selling, I think.
Dan, whilst I was flying home from Omaha, Nebraska, it is beautiful, by the way. The Apple earnings report came out. You obviously discussed it on CNBC's Fast Money last night. By the way, that's 5 o'clock Eastern time. That show is now 16 and a half years old, which is quite remarkable. I saw the numbers. I went through them, obviously, on a very sort of, tertiary level, I guess. And they didn't seem all that impressive to me. And Apple's become more expensive on the back of that earnings release, and with the stock appreciation, more so now. I'm not really. I think I understand to a certain point what the market's looking at. Danny mentioned the fact that they're getting rewarded for quote unquote being now part bank, which is really mystifying to me. Services continues to be a driver, but this is not a cheap stock, especially in light of the fact that you continue to see declining revenues. So people obviously don't want to focus on that, Dan, but it's out there if you want to just take a look.
Yeah, so when you think about services being a driver, I mean, it came in at 5% year-over-year growth. So when this stock got re-rated, right, so this was trading below a market multiple for years before like this service component kind of came into the mix, because the mix shift of their margins was going to be a lot better away from their hardware margins. And again, in the smartphone industry where they have, they have like 20% market share. I just want to be really clear about that globally. I mean, a lot of people think because everyone in America has an iPhone. That is not the case in other parts of the world. And so when you think about their market share, but you also think about their margin, they also take about like 85% of the gross margin in the entire smartphone industry. So they better be able to maintain those margins, reshoring a lot of manufacturing and reorienting their supply chains away from China should be put some pressure on margins. Some of the takes I heard is that they guided for flat margins, and we know that India, and they talked about India a lot, is going to be an important market for them. So they're going to shift a lot of manufacturing away from China. Over there, they talked about a 2 billion plus installed base that's growing. And I think about the services, and I say to myself, well, how is services only up 5% when they had more than 5% installed base growth, right? And so if the services just goes flat, okay, or like X growth here, I think that's a really big problem for this multiple at about 28 times. To your point, Guy, revenues and sales this year expected to be low to mid single digits at best. Next year, maybe mid to high, trading about 25 times next. The stock had just opened at $171. Okay, the high I think of the year is $175. The all-time high is $183. It feels like it's a foregone conclusion that it's going to go there. This is a $2.45 trillion market cap company that is not pricing in my opinion, at this valuation, any likelihood of a recession. And I think those are the things that I think are really important. Microsoft is another one, $2+ trillion market cap, where there's so much excitement about OpenAI and their investment and their integration of that into their products. And that's why I'll just come back to the fact that I think there's a lot of risk in a handful of names that have unusual excitement about it, where the fundamentals might be as good as it gets right now, especially relative to their valuation. So I don't know, man. I said this, I don't know if you were watching on the plane on the way home, Guy. My final trade was Apple sell in May and go away. And then I actually name checked you, as the kids say, because I knew that if you were sitting in 26B in the middle seat, as he does, looking like Private Pile, remember Private Pile,
sure.
just staring ahead, that if I had said that and you had your DirecTV on, that might have really twerked you.
Full Metal Jacket, without question, R. Lee Ermey. And speaking of R. Lee Ermey, somebody about as old as he. By the way, he was fantastic in that movie.
Yeah.
So, Stu, it's interesting. Obviously, Dan spoke to it. Danny did as well in terms of Apple and what they're getting themselves into. Obviously, they want to sort of, I guess, immerse themselves in as many businesses as they see viable. But banking seems now to be one of them. And we've talked about this before, but how do you view Apple? Competitor? Are they somebody you can sort of coexist with? How does that sort of line up with what you're doing at Current?
Yeah, I think it's interesting what they're doing here. Obviously, banking is not a primary business for them. They're in the business of shilling iPhones globally, as Dan already mentioned. And I think, when it comes to falling sales of iPhones, we've already hit peak iPhone, and now it's a market share game, as everyone has already sort of identified. And so they're using banking, and they're using a traditional banking tool, which is like show a really high interest rate, a high yield, and you'll get a bunch of customers. And I think it's just this weird juxtaposition where they're using this sort of blunt tool to go and get iPhone sales. So I'm really interested. They sort of rolled this out in Q1 into the early part of Q2. I'm interested to see if that is effective for Q2 and Q3 iPhone sales. Did people get iPhones because they wanted to get 4.15% interest rate yield? And so we should be looking at that as a framework, I think, or as a lens to understand if they're really going to build upon their financial services products. I don't think this is meant for them to make money. Why are they showing such a high interest rate, even compared to the 3.9% of markets? I think the reality and the sort of sobering reality for the banking fraternity is that they don't need to make money. This is CAC. This is customer acquisition cost. This is engagement. And so it's a really interesting dynamic that has come through. It is not directly competitive to us for all the reasons that we've said over the years. But I think for maybe a JP Morgan or one of those money center banks, it's kind of worrying. Right.
Yeah. Well, you know what's interesting about it? So when I think about this is that if you have an iTunes account associated with an, with an iPhone or any hardware, you likely have your credit card in there. So they've already financialized this relationship. And then they also know that this growth that they've had in services, I think they look at this offering as just another service, right? They're going to be pushing harder into healthcare. They're going to have AR, VR headsets. They're wearables has been. So I think they're moving towards this recurring model because they have this financial relationship with you. And so this is something actually, I just said the sell in May and go away bit as it relates to Apple. I'm actually, if there was ever like a reset in this stock, and again, as we get, let's say, to the other side of this economic period that we're in, I actually think because of that 2 billion installed base, space, they are primed to do a whole host of things. And I actually think it will grow back into this sort of multiple, but there needs to be a little bit of fear in it. I just don't ever think that they are going to be a financial behemoth. I think that they see it around the edges as a really good place to be, because it does, when you have a bank account or you have some sort of financial relationship, it makes that relationship that much stickier.
Everyone wants the ecosystem. Everyone is going after the ecosystem. There is revenue diversification. There is customer engagement benefits. And so you're seeing that from the hardware. You look at Tesla, you look at Apple.
You look at it. I look at, as you said earlier, cheekily every morning. I look at it.
I do. I'm also in your camp with that one in the short term.
Yeah.
But what we're seeing here is like exceptional valuations and exceptional valuations from these companies, because people have already priced in these ecosystems sort of dominating everything in every vertical. And I just don't think that will happen, but it will be pretty good for those companies. They should trade at a premium. It's just probably not at the premium that they're currently priced in.
Yeah, and one other thing I think it's important, kind of end the week here with Apple. This was the last big tech company. There is actually one more. So NVIDIA is going to report on May 24th. And I thought what we heard from semis and some of the competitors in NVIDIA this week, there was actually some really big news. We started the week with Arista Networks, and some of their biggest customers are some of the cloud operators, Meta, Amazon, Google, Microsoft, and they had a big warning actually, and they said they see softness here. And so I think if you're trading a lot of these techs on what was reported for the last 3 months versus what they're saying right now, it's probably incorrect in my judgment. Also, we had AMD results this week. They talked about weakness in data center. Qualcomm, we talked about weakness in handsets. When I look at the handset numbers, and Qualcomm is Apple's a 20% customer of Qualcomm. Apple told us that China was okay. Okay, it was up year over year, but there was a lot of pull. Like I guess they recaptured some sales that they missed in the last quarter. And I put together what China did relative to the recapture and the reopening, and then what service is telling me. I'm not that optimistic about the current quarter, and this June quarter is always a weak one for Apple. The last thing I'll just say about Apple, on June 5th, they have the Worldwide Developers Forum, and they're going to talk about AI. They're going to talk about every buzzword you can think of. They're going to talk about the financial products. They're going to talk about AR, VR. They're supposed to announce some sort of high-end handset. So those are all bullish things. I just don't know how you buy the stock going into new 52-week highs of 40% from the January lows. And just the last point, Guy, and I got to get your take on this because this happened yesterday afternoon, that Microsoft and AMD had an announcement, or I don't know if it was an announcement, but it was something that leaked, that Microsoft is going to help finance at least the build out of AMD's advanced AI chips, which is basically, we know one of the reasons why NVIDIA is up 90% on the year, up almost 200% from its lows, is the excitement around the chips and the platforms and the services that they have geared towards AI, and there is a shortage of them. NVIDIA barely sold off. AMD rallied 10% at its highs on that news, and it just seemed a bit shocking to me. I just feel like this NVIDIA bubble is probably close to bursting. I have a position playing for that in the next month and a half or so, but this has been a really dicey trade here, and NVIDIA looks like the new widowmaker in the market.
Yeah, no question. I mean, that's been my thought as well. But I've been thinking about that NVIDIA probably for the last 30%. So that's clearly been wrong. But that Microsoft AMD announcement or headline is clearly a shot across the bow to NVIDIA for whatever reason. Maybe there's a collective fear that NVIDIA has sort of gotten itself off and running in this race and are just sort of not looking back, and everybody else is sort of an afterthought. And maybe Microsoft and AMD needed that type of partnership to stem the tide. But in terms of semis, the have and the have-nots, it's stark, actually. You look at NVIDIA on one side of the equation, AMD finds itself sort of in the middle, and that 10% move to the upside basically offset the move we saw post-earnings. But then on the other side of the spectrum, you see a Qualcomm trading at about 106 or so, and that's within an earshot of its 52-week low I think we made in November. So the juxtaposition, a lot of these semi companies are just fascinating. And if you've tried to play the valuation game and the pair trade game, it's been a tough slog over the first 5 or 6 months of this year. And that seems to want to continue. Before we get out of here, this Lyft Uber stuff, Dan, I think is interesting. It's sort of coming across as we've been speaking. What are your thoughts on potentially bit of a price war potentially going on with these two guys.
Yeah, so Lyft founders are out as CEOs. That was announced, I think, about a month ago. And, they have a new CEO, and he just lowered the bar. I mean, the stock's down 18%. It's trading at a multi-year low here. And again, this company that I think from an EBITDA standpoint, the story was how can they get to profitability? Okay, so that's kind of out the window. The new CEO said basically they have to re-engage some market share, both in drivers and then obviously customers. Uber had a great week. I mean, Dara I think continues to prove to be like just an A+ CEO. He's basically hit all of the targets since the pandemic that he said he was going to do. They were going to get to EBITDA profitability. They're going to get to free cash flow positive. They were going to get to GAAP profitability, which they're making progress. The stock, I think, was up 15 to 20% on its results and the guidance that it gave this week. And so it's down a little bit today because of that Lyft price war. I look at Lyft, and I'll just say this, when you think about all of the data that they have and all that we hear about autonomous taxi fleets and this and that or whatever. And this is also something I think Apple is likely to get into at some time in the not so distant future, or something as it relates to autos is probably more of the infrastructure software, if you will. But this has a $2.5 billion enterprise value. This is Lyft right now. And I just say to myself, 3.3 billion market cap, 1.8 billion in cash. Yes, they're losing a little money, 1 billion in debt. It's just too cheap of an asset. And we also know this, and Stuart, I want to get your take on this, is that we know here in America, even when there is a dominant player like an Uber as it relates to market share, and they're getting stronger and they're getting towards profitability, which is only going to let them flex more and more, it is favorable to have a number two, no matter how weak it is or so. So how do you think about the potential for a price war? Do you think it's the thing that drives Lyft to zero, or do you think it has any meaningful impact on Uber? And how do you think that Dara is looking at this and saying, we got this? You know what I mean? I'm just curious how you think about it, because customer acquisition and market share, those are all things that are always top of mind for you.
Yeah, absolutely. Well, I hope there's a price war.
Yeah. As a consumer,
as a consumer, if you've taken an Uber in New York City over the last couple of years, it's only gone one way. So from personal consumption, that would be great. I think here you're sort of looking at the ecosystem versus the vertical, and we can sort of tie this back to the Apple talk and the Tesla talk. Is Uber has an ecosystem, right? And so they don't just do consumer; they also do B2B. They do Eats. They have their Eats product is a phenomenally successful product. When you look at Lyft, they're just a vertical, right? They do rideshare only, and so because they don't have that revenue diversification, because they don't have that ecosystem that Dara has really built out, and he's executed on, like you've just said, he's a real class player. They're gonna struggle. They've got one lever, right? They've got one lever, and it's price. And so I think this continues. I think the price war from a Lyft point of view will continue, but the ecosystem of Uber, I think, ultimately wins unless Lyft can get the investment and the product build out to really compete. Also, fun fact. Founder of Uber gave Current its first check.
No way.
Yeah, that's right. Garrett Camp.
Oh, that's cool. Yeah. All right, fair enough. All right, here's one other question for you. This one reports next week. This is Robinhood, and I think this is kind of also in your wheelhouse. And this thing I was looking at it last night on Fast Money because we were talking about Coinbase's earnings, and obviously they're 100% exposed to crypto assets, right? And they also have this SEC investigation, as well as notice was issued to them. I think it was in March about some of their staking products and some of the other my answer to Melissa Lee is if you're interested in potential upside in exposure to crypto coming back as a trading kind of vehicle, and it was hugely profitable for Robinhood back in the day, I'd say why wouldn't you just go to a Robinhood? The sentiment couldn't be worse. We know a lot of those retail traders have been taken out. We still know that they have a pretty decent customer base at a demographic that I think a lot of financial services companies like you are happy to serve, because as you layer on more products and services, you want to get those customers early. I look at Robinhood, and Guy, I definitely want your take here too. $7.8 billion market cap, $6.2 billion in cash. Remember, this was one of the biggest IPOs in 2021, and only 1.5 in debt. And I say to myself, they got exposure to anything you want to YOLO as far as stocks, ETFs, options, commodities, these, so I look at this thing and I say, okay, they're still losing money. That's not a great place to be in this sort of environment, right? But, revenue growth, I think, is probably, or at least the deceleration in revenues from 2021 to 2022, we're back near the expected peak. It was $1.8 billion. I just say to myself, this is kind of a cheap-ish asset, and it gives you exposure to the retail trader coming back to traditional markets, but also to crypto. And I'd rather be there, I guess, than Coinbase, given the regulatory overhang and some of the fee issues that they have.
Yeah, I think that's fair. I think it's a well-run company. They've taken a different angle. Obviously, they're under a different regulatory authority with the broker-dealer and all that other stuff. And so I think your comparison to Coinbase is fair. I think the regulatory capture in the US is brutal, I think is the right word. And so if it's your primary business, you've both seen like the Gemini, the Winklevoss twins, and Coinbase start offshore entities the last 2 or 3 weeks. I think that says everything. They're sort of saying, okay, America is not the home for Bitcoin and some of these currencies, cryptocurrencies. And so when you look at Robinhood, its primary business is obviously retail investing, synced up to Citadel, and I think that's not going away. It's well positioned for a bounce, as you say. All those numbers look pretty good to me. I would say this: they need to start building that ecosystem. Maybe they need to start getting into banking or other things like that, content, things like that. And they got all that cash, so they should get going.
52-week low in the stock was, I think, $6.81, trading 8 3/4 right now. I mean, the stock is effectively flatlined, which was a great movie, I think, with Kiefer Sutherland and Julia Roberts back in my day since January of 2022. But in terms of risk reward, it probably sets up pretty well.
So in 2021, when they had $1.8 billion in revenues, they lost $3.7 billion. Last year, they had just under $1.4 billion in revenue, and they lost about $1 billion. This is in GAAP net income. This year, expected to get back to $1.8 billion, but only expected to lose, I know this sounds crazy, $600 million. Next year, they could be GAAP profitable. Okay. So to me, what I want to do is take a small position into this thing. If there is a gap lower, that would be GAP, not GAAP. Okay. Then I'm going to load the boat. And if it ever got guide towards those lows, think about this. This was like a bell ringing moment. There was a lot of companies that lost 80% from their highs from 2000 into the lows in 2002. And one of the really interesting indicators for me is that some of those companies did a great job raising cash at the highs. And when their equity value got close to their cash value, it was almost a bell ringing at the bottom. And some of those companies were up 200-300% over the next year or so. And that's kind of how I would be thinking about a Robinhood right here into its print next week.
I think with Robinhood, you're playing the interest rate curve, right? So a lot of broker dealers, when the market goes sideways and interest rates go up as rapidly as we've seen, they become net interest income machines rather than sort of fee-based machines. And so if you think it's high for longer, I agree with you, Dan. I think they're going to make a lot of money.
Interesting play here. As we sit here before we 5,000, 402 S&P names have printed. 71% of them beat on EPS, 78% beat on sales, and 58% beat on both. So the S&P is now tracking at a 4.1% EPS beat versus the consensus expectations. That's coming from our friend Savita Subramanian at Bank of America. Just something to keep in mind. Next week, the two biggies, I think, in terms of earnings, Disney on one end, PayPal, which can't get out of its own way, on the other side of the equation. I want to thank Stuart Sopp for joining us. Thanks for indulging me with my Sir Thomas Wyatt, but I'm telling you, the more I think about it, the more I am on to something. Dan Nathan, you're the man, the great Danny Moses as well. As they say, smash the like button. Check us out in your favorite podcast store, and we will no doubt be back next week with another episode of the On the Tape podcast.